The playing field is tilting further away from property investors thanks to APRA's new capital proposals. We look at the changes. Hi, I'm Martin North, Principal Analyst at Digital Finance Analytics. This week, the body charged with supervising the banks, the Australian Prudential Regulatory Authority, or APRA for short, released 2 discussion papers for consultation with authorised deposit-taking institutions, or ADIs, on proposed revisions to the capital framework. Now, this may sound a dry subject, but the implications for the mortgage industry and the property market are potentially significant. In addition, APRA finally recognises the risks in the mortgage system, and this in itself is a welcome, if belated, change. In summary, the proposed changes to the capital framework include lower risk weights for low LVR mortgage loans and higher risk weights for interest-only loans and loans for investment purposes than apply under APRA's current framework. Amendments to the treatment of exposures to small to medium-sized enterprises, SMEs, including those secured by residential property under the standardised and internal ratings-based approaches. Constraints on the IRB ADI's use of their own parameters established particularly for exposures, and an overall floor on risk-weighted assets relative to the standardised approach. And a single replacement methodology for the current advanced and standardised approaches to operational risk. And the paper also outlines a proposal to simplify the capital framework for small ADIs, which is intended to reduce regulatory burden without compromising prudential soundness. So whilst the overall capital ratios will not change that much, there is a significant rebalancing of metrics, and banks with more investment and interest-only loans will be most impacted. So getting an investment loan will be somewhat harder, and this will impact the property market. The proposals are for consultation with a closing date of the 18th of May 2018. So if you just want an overview, I suggest you stop here, because now we're going to look in more detail at what APRA said about the risks in the mortgage industry and the new measures they propose. As part of the discussion paper, APRA says that addressing the systemic concentration of ADI portfolios in residential mortgages is an important element of the proposals. They have finally woken up to the risks in the system just years too late. We have significant numbers of loans in the system currently that would now not pass muster. And their proposals, which focus in on mortgage serviceability, would change the industry significantly, as lower risk loans will be more highly prized and so expect lower rate offers for lower LVRs, whilst investment loans and interest-only loans are likely to cost more and will be harder to find. Combined, this could certainly move the market. The proposals introduce standard and non-standard risk categories. As well as increasing the risk weights for some mortgages, they also continue to close the gap between advanced IRB, internal approach used by large lenders, and the standard approach used by smaller players. Those in transition between the two, for example Bendigo Bank, may find less of an advantage to move to advanced as a result. Also, APRA are proposing some simplification for small ADIs, as the costs of these measures may outweigh the benefits to prudential safety. Proportionate and tailored requirements for small ADIs could reduce regulatory burden without compromising prudential safety and soundness. Here are some of the key paragraphs from their paper. APRA's view is that there are potential systemic vulnerabilities to the financial system created by high levels of residential mortgage lending for investment purposes. As noted by the RBA, they say, investment lending can amplify borrowing and house price cycles. Periods of rapidly rising prices can create the expectation of further future price rises, drawing more households into the market, increasing the willingness to pay more for a given property, and leading to an overall increase in household indebtedness. Similarly, the significant share of interest-only housing lending, including to owner-occupiers, is a structural feature that increases the risk profile of the Australian banking system. Interest-only borrowers face a longer period of higher indebtedness, increasing the risk of falling into negative equity should housing prices fall. Borrowers may also use interest-only loans to maximise leverage or for short-term affordability reasons. Even though loan serviceability is now tested at levels that include the subsequent principal of repayments, borrowers may face payment shock when the interest-only period ends and regular repayments increase, in some cases significantly. This payment shock is particularly acute when interest rates are low. Over the past 2 decades, they say, residential mortgages in Australia as a share of ADI's total loans have increased significantly from just under half to more than 60%. While losses incurred on residential mortgage portfolios in this period have been limited, this level of structural concentration poses potential and financial stability risks, particularly in an environment of high household debt, high property prices, weak income, and strong competitive pressures amongst lenders. In such circumstances, households, individual ADIs, and the broader banking sector are vulnerable to economic shocks. A key focus is the appropriate capital requirement for investment and interest-only mortgage loans. Although, as a class, investment loans have typically performed well under normal economic conditions in Australia, this segment has not been tested in a nationwide downturn. Further, an increasing proportion of highly indebted households own investment property relative to past economic cycles. Experience in the United Kingdom and Ireland during the global financial crisis, for example, showed that previously better performing investment loans can fall into arrears in higher volumes than loans to owner-occupiers in times of stress. So now they propose to target higher risk residential mortgage lending, balanced against the need to avoid undue complexity. Under the proposals, residential mortgage exposures would be segmented into the following categories, with different capital requirements applying to each segment. First, loans meeting serviceability requirements made to owner-occupiers, where the borrower's repayments is on a principal and interest basis. Secondly, loans meeting serviceability requirements made for investment purposes or where the borrower's repayments is on an interest-only basis. And thirdly, other residential property exposures, including those that do not meet serviceability requirements. Specifically for the standard approach, APRA would require ADIs to designate as non-standard eligible mortgages those where the ADI, first, did not include an interest rate buffer of at least 2 percentage points and a minimum floor assessment interest rate at least 7% in the serviceability methodology used to approve the loans. Next, did not verify that a borrower is able to service the loan on an ongoing basis, i.e. positive net income surplus, and approved the loan outside the ADI's loan serviceability policy. APRA is also considering excluding certain other categories of loans considered higher risk from the definition of standard eligible mortgages, such as those with very high multiples of borrowers' incomes. APRA proposes to amend its existing requirement that loans to self-managed superannuation funds secured by residential property should be treated as non-standard loans, reflecting the relative complexity of these loans and the fact that ADIs do not have recourse to other assets of the fund or to the beneficiary. APRA also proposes that reverse mortgages, which are currently risk-weighted at 50%, where the LVR is less than 60%, or 100% for LVRs over 60%, should be treated as non-standard in the light of heightened operational, legal and reputational risks associated with these loans. Subject to final calibration, APRA proposes that all non-standard eligible mortgages will be subject to a risk weight of 100%. APRA proposes to segment the standard eligible mortgage portfolio into lower risk and higher risk exposures, in addition to assigning risk weights according to the LVR. This approach is aligned to, but deliberately not strictly consistent with, the Basel III material dependence concept to reflect Australian conditions. For the lower risk segment, APRA proposes to broadly align the risk weights with those under the Basel III framework loans, where repayments are not material dependent on cash flows generated by property securing the loan. This category would include owner-occupied principal interest loans and would apply after consideration of any lender's mortgage insurance, LMI. The higher risk segment would include interest-only loans, loans for investment properties, and loans to SMEs secured by residential property. The determination of higher risk weights for this segment would be either by way of a fixed risk weight schedule or a multiplier on the risk weights applied to owner-occupied principal interest loans. The benefit of a multiplier is that APRA could more easily vary the capital uplift for these higher risk loans over time, depending on prevailing prudential or financial stability objectives or concerns. This table shows the indicative proposed risk weight schedule based on the Basel III risk weights for materially dependent residential mortgage exposures. APRA is also considering whether exposures to individuals with a large investment portfolio, such as those with, for example, more than 4 residential properties, would be treated as non-standard residential mortgage loans or as loans secured by commercial property. APRA is looking for feedback on this issue. APRA expects to continue to incorporate relatively lower capital requirements in the standardised approach for exposures covered by lenders' mortgage insurance. LMI can reduce the risk of loss for an ADI subject to meeting the insurer's conditions for valid claims and the financial capacity of the LMI to pay claims. APRA is considering the appropriate methodology to recognise LMI in the capital framework for both the standardised and the IRB approaches. For the standardised approach to credit risk, APRA expects that any capital benefit would continue to apply to loans with an LVR over 80%. APRA's preferred approach is to increase risk weights as finally calibrated for standard loans with an LVR over 80% that do not have LMI. For the IRB approach, APRA is considering potential options for the recognition of LMI. And more broadly for IRB banks, those who use their own internal models, APRA believes that material changes are required in Australia in order to first improve the alignment of capital requirements with the risks for particular exposures. Next, address the FSI recommendations that the difference in average mortgage risk weights between the standardised and IRB approaches is narrowed, and to ensure an appropriate overall calibration of capital for residential mortgage exposures, given the concentration of IRB ADI portfolios in this segment. So they propose to increase the capital weights on interest-only and investment loans, similar to the standard approach. They also will make some changes to other metrics, including probability of default and risk of loss. Non-standard mortgages will be required to use the same ratios as in the standard capital approach. On their own, however, APRA says, these IRB mortgage risk weight functions are not expected to result in a significantly high level of capital to meet APRA's objectives for increased capital for residential mortgage exposures. So as a result, other adjustments are likely to be necessary to meet those unquestionably strong capital expectations. For residential mortgages, this is expected to be through additional risk-weighted asset overlays on top of the outputs of the IRB risk weight function, including both an overlay specifically for residential mortgages and an overlay for total risk-weighted assets. The exact form and size of these overlays will be determined after APRA has completed its analysis. In determining final calibration of the regulatory capital requirements for residential mortgage exposures, APRA will consider the appropriate differences in the average risk weights under the IRB and standardised approaches, consistent with a recommendation from the FSI. As detailed in the final report of the FSI, given the IRB approach is more risk sensitive, some difference between the average risk weights for residential mortgage exposures under the different approaches to credit risks may be justified. However, it should not be of such a magnitude as to create unwarranted competitive distortions. SME exposures secured by residential property that may meet certain criteria would be included in the same category of exposures as residential mortgages for investment purposes and interest-only loans. In APRA's experience, these exposures have historically had higher losses than non-SME owner-occupied residential mortgage exposures. For SME exposures that are not secured by property, APRA proposes to reduce the 100% risk weight currently applied to 85%. This gives some recognition to the various types of collateral other than property that SMEs provide as security. APRA does not propose to implement the Basel III 75% risk weight for retail SME exposures, as there is insufficient empirical evidence that retail SME exposures in Australia exhibit a lower level of default or loss experience through the cycle than corporate SME exposures. SME exposures in this category would be limited to corporate entities where consolidated group sales are less or equivalent to $50 million. So standing back, APRA has finally woken up to the risks in the mortgage system in Australia. But of course, many loans are in the system with higher risks than will be accepted today. The changes will make pricing of mortgages for lower loan-to-value owner-occupied borrowers a little lower, but will lift the price of investment loans and interest-only loans. Given the fact that 36% of all mortgages are for investment purposes, this will likely be a further brake on the investment sector and a drag on future home price growth. If you found this useful, do like the post, add a comment, and subscribe if you have not already done so to receive future updates. I'm Martin North, Principal at Digital Finance Analytics. Many thanks for watching.